The beauty of Bitcoin is you put it in an asset that can grow and be a hedge against inflation so that your currencies don't lose money when they're in their bank account.
We believe that the price will be tenfold.
For every 3 Bitcoins that's bought, no more than 1 Bitcoin moves out of or sold. I don't think that we're going to have the same 4-year cycle. If you were to think the end of the 4-year cycle is a 1-year bear market, like a 1-year bear market and an 80% pullback, I think that that's gone. I think a lot of the FOMO gets hit on its head because you've got sell pressure coming from all of these new players, and then the underlying demand can push it up in a rally again. And then good news in that you won't have to wait through 1 year of 85% pullback. And so if you were to zoom out, I think the chart looks like a random walk at this stage, a random walk till saturation, whatever valuation that is. If it's 100 trillion, like Plan B thinks, then it's a random walk, up, down, up, down, up, down. Invalidate the stock to flow, right? It's not a demand and supply model, which is what I'm talking to here. Stock to flow just puts a number on it and says that's how much this network is valued next to real estate, next to gold, next to silver, and these other assets based on their scarcity. This is a high reliability metric to say we are in for a bull run for the next 6 months or even longer. It could go for another year. So it's a very good time to be accumulating. There's a whole series of these metrics which I've labeled supply shock. This is the equivalent of on-chain demand and supply. It's an alternative to stock to flow. It's an on-chain model, and we're looking on-chain for different ways in which to measure demand, which demand is like if you're holding Bitcoin every day, you're saying that's hodl demand. I'm holding it. I want exposure to the asset. The coins that are like that may potentially be supply. And these are the coins that aren't locked up in long-term holding situations. They look likely they may be sold. So you can run the ratio between demand and supply. So those guys that aren't selling are on the demand side, and the guys that might be selling are on the supply side. And you get a whole family of supply shock metrics. And Will Clemente was the first to suggest this in running this ratio. He suggested doing it on this thing that Glassnode created called liquid supply. Now, this metric was I talked to them and asked them if they could create something that look at the behavior of individual holders and their history so that we could kind of validate what was happening on exchanges. We were seeing that the coins were starting to deplete out of the exchanges, move into long-term storage. But I really wanted something that was more forensically accurate than just exchanges, because exchanges are very reliant on you tagging particular wallets as being owned by exchanges, and there's a lot of data errors. So they created this metric, and it's called liquid supply, and it looks back and it goes, all right, for this cluster of wallet address spaces, because on the blockchain, obviously, you only see addresses, you don't know who it is. They forensically cluster all of these address spaces together, and they resolve them to individual holders. And now you've got the individual holders, you look back across their wallet history and you go, okay, there's 3 categorization. What I call the Rick Astley, the guy that just keeps stacking and does not sell. For every 3 Bitcoins that's bought, no more than 1 Bitcoin moves out of or sold. So anything that's stronger than that is what you call like illiquid. They're not selling. That's always the bottom. It's always the bottom of a bear market, an accumulation phase or a reaccumulation phase, having pulled back from a prior run. And we're in that right now. And once we're at peak, right? We're at peak and started to round out, but we only had like a week or so of data but it looks about right. It looks about where we'll round out, and generally we stay at peak levels. Generally we stay at peak levels for a few months, but you can't rely on that. What actually is happening is these guys that have these coins that have aged more than 5 months, they start to sell once we get a very, very strong rally, and then you'll start to see this number start to decline. You would have seen this in the last run up from 10,000 to 60,000 from fourth quarter of last year, that like effectively the last generation of those long-term holders start to sell down, and these new guys came in to buy, right? I don't know if it's something you want to use for price signaling. Like if you can just look at it right now, and like it's said to sell at about 50,000, and now it just turned green today, which is 65,000 as I'm looking at the price right now. So it would have told you to sell low and buy high because it's a little bit laggy, but it's really telling me the structure of the market, that we've been in reaccumulation in these strips. So I'm liking it as a sort of a big zoomed out structure of the market. And it's now we've got, two small red strips, no more than not even close to a year each. And I think that's actually the sign of to what's coming. These big 4-year cycles are ending. It's really interesting now because you've got this ETF, which is futures based. So in theory, you can buy more than 21 million Bitcoins. That's a starter, right? You can buy more than 21 million Bitcoins through ETF exposure. Of course, the underlying doesn't change. It's, in a futures market, you can trade to infinity as long as you can find someone on the other side that's going to sell you that paper contract. Obviously, like the ETF is going to increase the derivatives dominance, the volumes on the derivative exchanges. That is on the CME, which is not physically settled; it is settled in cash. But so if you wanted to buy in, you'd still need to you'd do it on offshore exchanges, which are physically settled.
And
you might take the paper contract temporarily whilst you fill your spot position, right? So if I'm going to buy like $1 billion of Bitcoin, I'm not going to dump it in the spot markets. I might buy 200 million on spot markets, and I'll buy the rest on derivatives because I can deploy right now. And then the price is going to run up, right? But I'm fine because I've locked in my price in that one hit. So I'm getting a cash settled profit. I take the cash settled profit, I pull it over to Binance, FTX, some of the offshore exchanges, which physically, trade. You can even do it on Coinbase, right? You just buy it on Coinbase using your cash profits. So you, through a proxy, you can physically settle. That's relatively easy to do. It's not the same as like maybe the futures of gold, where you get cash and now you've got to still find the supplier that's going to sell you that gold, and they have huge spreads, whereas the spread on spot is so tight.